This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with the focus on one-to-one engagement with portfolio manager and Edge economics advisor, Geoffrey Fouvry, and derivatives advisor, Hans Albrecht, as well as a direct access to LaDuc trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Hey, greetings and welcome to Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaDuctrading.com, joined in our last appearance together with Craig Shapiro, our macro advisor, Edge manager, and someone I've worked with for 6 years. So I'm very glad that we can kind of do this capstone send off and also discuss everything Fed. We were just talking about how we hate Fed Day. In the morning when I run that live trading session, it's like watching paint dry. You might have one good chase, long and short, but otherwise we're just waiting, right, for Godot. And then you get this 2 o'clock FOMC statement, 2:30 Powell presser, and you've got a lot of, it's like paint getting splattered. So directional moves are not to be trusted. And we had a lot of that. So we really have to wait, honestly, to get through monthly Friday options expiration to get a better feel for trend. But for right now, we're going to kind of go through macro, what just happened with not only the FOMC rate cut of 50 basis points, which was a great title, by the way, for our webinar topic, call it lucky or good. It was go 50 or go home. They went 50, but they're a little bit more hawkish on the trailing.
The problem is it was like they went 50 and they're going home. Unfortunately, given looks like the way that they tried to communicate the message. But yeah, this is
talk about this miscommunication leading into Friday, and then all of a sudden we went from 14% odds of a 50 point cut into 66% this morning, but it was 61 on Monday. So what was it that they got for data during the blackout period that you think pulled forward this aggressive hike? Cut, my goodness sakes.
Look, I mean, the Fed has botched this communication, I think in a large way, and well, it is what it is. I think in hindsight, they probably viewed the decision not to start in July as a mistake, although they'll never admit it. I mean, Powell did say on the call, on the press release, press conference that, because of the way these negative revisions came in for the labor market, undershooting by 818,000, maybe if we had that data, we would have realized the labor market was, not as robust as we thought. And, so I think they should have they should have started this in July at 25, and then they could have done 25 here. So this was a little bit of catch up. Now, last week, a week ago, the odds were about 85-90% that they were going to cut 25 basis points, and then they sent out the press with Nick Timiraos and the FT and John Hilsenrath, and then Dudley and several others kind of saying, hey, not so fast, maybe 50 would make sense. There's some reason to do that. There's catch up, whatever. The data that came out during the blackout period really, I don't think should have pushed them to 50 if they were at 25, but because the data was inflation data that came out a little bit warmer than expected, although still showing signs of returning back to 2%. The housing data came in better than expected. The retail sales numbers came in better than expected. So no real reason that data should have moved them from 25 to 50, but I guess what they wanted was the odds of 50 to be at least 50%, and then they got up to 70% earlier this week, because I think that they wanted to have a conversation today about that at the Fed this week about it, and so getting the odds up allowed that to happen. And then in the room, look, I think they probably just went back and forth, and half the folks were for 50 and half the folks were for 25. Don't upset the apple cart. No reason to try to make up for the mistake, and they kind of got to 50 in the end. Bowman dissented, which I think is actually quite important, because look, she's a governor, and this is the first governor dissent to a Fed meeting in 19 years. So there's clearly uncertainty inside the Fed about the pace that they should be cutting. But look, they got off the ground, right? They cut 50. They wanted to make a big statement that they're not going to let the labor market deteriorate significantly, get away from them, and lead to a more protracted growth deceleration near term. So they got off the ground. Now, the issue that I think they were wrestling with was, well, if they go 50, how did they try to communicate that every meeting is still going to be a live meeting and not just be a 50-50-50 cutting regime? Because that's what the market likes to do, right? The market gets 50 and says, thank you, we'll take another 50 next month, then we'll take another 50 in December, and let's get rapidly back to neutral. And I don't think the Fed wanted to do that because, frankly, they don't really know where neutral is. So they don't really know how quickly they should be getting back to some semblance of neutral. They also know that a cutting regime is going to kick off a further easing of financial conditions. And what I noted earlier today was, financial conditions, according to the Chicago Fed metric, are as easy today as they've been for any point of the tightening cycle. So we're going into the Fed cutting cycle with financial conditions incredibly loose. We know that cutting will make financial conditions even looser. How do we prevent the market from just going hog wild here and taking risk assets to the moon, crushing the dollar, animal spirits go up, inflation expectations go up? And so what they tried to do was they tried to use the dot plot in a hawkish way. They tried to say, well, you market are looking for rate cuts at, of maybe 125 basis points this year. We're not going to give that. You're looking for a rate at the end of 2025 below 3%. The market was looking at like 2.89%, 9%, 2.9%. We're not going to give you that either. And so the dots for 2024 came in at 4.4, and they're 3.4 for 2025, which are basically, for 2025, is basically 50 basis points above where the market was thinking. So this is less. This is the Fed saying, look, we're doing less. Now what was the market reaction? We don't believe you. We know you're going to do it. So that was the dot plot. That was the release of the information up until 2:30. Most of the press questions were about, what does this mean? Powell was evasive, and I think he was just wanting to get out of there as quickly as possible. But I think, and we'll go back and look again, but what I think turned the market a bit intraday was a comment that he made about the neutral rate, because he was asked, and look, this is the first time that he really specifically said that he does not believe that that we're going back to a regime of low interest rates, and that the neutral rate is higher than it was pre-COVID. Now, he's the chair. That's important. And if you don't believe that neutral rate is as low as it was historically, and it's likely higher, that means that the amount of easing that you could do before you get to neutral is less. And so if we have less easing before we wound up hitting neutral, that means the Fed probably is going to either be slower or do less, because once we get to, if they cut past neutral, that means either the economy has completely rolled over, in which case they need to, or the economy is fine, in which case inflation is going to reaccelerate quicker. So I think that realization of a higher neutral rate is what sparked the bond sell-off, which then led to the dollar finding a floor, which then led the algos to go wild and start to sell stocks and kind of reverse part of the move. Gold, was up 1% and closed down 60 basis points. Massive intraday move in gold. Obviously, the biggest and most crowded names that we've had for the last few weeks, utility, staples, healthcare, were the underperformers today on back of that yield move. 10-year yields finished up at 370 after ticking below 364. 30-year yields, 402. So the bond market sold off, the curve steepened, and equities are kind of stuck in this like, wait a minute, I thought we're getting a lot of easing. Yes, we want more. You're not giving us more. Is that what we really want? So I don't know. I think that's the summary of kind of the quick and dirty summary of how we got to a market that traded, S&P's being down a little bit on the day. But look, the other thing we need to keep in mind is expiry, right? Not only was the option expiry for today enormous, and vol for today was enormous, meaning right when at 2 o'clock we just mathematically sell vol, right? It's just because that a lot of that position, so much of that positioning gets cleaned up at the end of the day. But then we have expiry on Friday, which is over $3 trillion of notional outstanding, which needs to come off the boards as well. So it's a circus until maybe the open on Friday. But again, broadly speaking, I think what I learned is a Fed that knows it needs to stimulate, knows the economy is showing some signs of strain, but doesn't want to deliver the pace of easing that the market was expecting. And so there's disappointment there versus what was being priced. And I think if I look at the way things ended, I'm largely kind of seeing that. I'm seeing bonds down, I'm seeing dollar up, I'm seeing gold down, seeing stocks flat to down, things that have worked underperforming, laggards, so there was a bit of we traveled very far into the direction of a massively dovish Fed. And when you don't get that, you have to unwind some of that stuff.
So two of the money quotes that I captured and tweeted, because obviously I had the trading room open this afternoon. One, when Powell was asked about the cut, said, why now, right? Since there was no mention, data was collected during the blackout period, said a lot of data came in, including during the blackout, where payrolls may be revised down. So in speaking to that point, definitely the spike was tempered at that point. And we have jobless claims tomorrow, another, non-farm payrolls before next meeting, et cetera. So there's clearly more worry about the labor market under the hood. And then the second one, which wasn't even related, actually, there was one before, one during, one after. The one before was actually Bank of Canada that has already cut 3 times their 75 basis points, saying they expect more and faster cuts in the future. That came out right beforehand. Powell's comment, and then Fitch came out and, in response to U.S. banks, said shorter asset durations will lead to faster repricing of fixed rate assets, potentially increasing net interest income volatility. They're not saying banks are going to roll over with their net interest income, but that's what they're not saying. But they are going to have more volatility. When that happened, I went right to the JP Morgan chart. And there was clearly some weakness that came in after that release by Fitch on U.S. banks. We need banks, period. That's been a big tell. Next time we really do have banks roll over, tech will follow. But for the meantime, any comment on that aspect of the Fed cutting, hitting bank credit lending?
Look, there's a historical case to be made for that interest rate cuts become stimulative and lead to a reacceleration of bank lending, and the economy really takes to the cuts and does fine. I mean, that happened in 1995, and there's been other examples where that Fed easing kind of arrests the growth concern and things are okay. And in those environments, all systems go, markets react very positively to the rate cutting regime, and the economy responds positively, and everything's good. And then there are countless examples of when the beginning of a rate cutting regime is a sell the news, sell risk event. Whether it's 2007, there's countless examples of the idea that the Fed is cutting rates because the economy is already slowing. and that they are just chasing an economy down. As it slows, they have to cut more. The economy doesn't respond to the cuts. They need to do more. And look, I think the jury is out. My bet is that the economy is going to continue to slow and is going to need more accommodation. And it's not just about the US economy, it's about the global economy. I mean, China has been in a more of a deflationary growth slowdown for quite some time. It seems like it's getting worse, or at least staying as bad as it's been, with no real hopes of stimulus. And so that's exerting a deflationary kind of force on the global economy. Germany is close behind it. And so I think that is going to continue to drag down the more cyclical parts of the economy. And then for the more rate sensitive parts, look, if you're a consumer and you're looking to, let's say, buy a home, I mean, yeah, you just heard that rates were cut 50 basis points. Mortgage rates are obviously already down 150 or 200 basis points from the highs.
Yep.
But you may be thinking, hey, they're just gonna go down further. Why am I in a rush? What am I rushing for to buy a home right now when I know rates are going down? Now, on the margin, if you have a high credit card balance, rate cuts are eventually going to get credit card companies to lower your rate, but there's a lag there too. So the stimulative impact from these rate cuts, I think it's just not going to do much right now for this economy. Most people, I mean, if you look at the NFIB survey, is not talking about cost of capital as a deterrent for growth. They don't even talk about the cost of capital. So lower rates are not really going to necessarily stimulate a lot of demand at this point. I think as we get further into a cutting cycle and we bring rates down and we bring down borrowing costs out the curve, sure, but I think the first moves are not going to be great. Now, as far as banks are concerned, look, banks have an issue whereby they have high funding costs because deposit rates and CD rates are tied to the front end of the curve. And the curve out to, let's say, 5 years where they do most of their lending, except for mortgages, the curve is very inverted. So, they get deposits cost them 4.5%, and a 5-year, loan. I mean, 5-year US Treasuries are at 350, and IG spreads are 55, 60, 70 basis points. So 5-year loan on a high grade credit is 4.2. You're making no money on this. So that is what JP Morgan mentioned last week. They talked about lower net interest margin, no net interest income for 2025, is this dynamic of that the curve from 3-month to 5-year is very inverted. And so folks are focusing too much on 2s, 10s, or 5s, 30s as, yes, this is great for banks and this, steepened curve, but it's going to take some time because they need their funding costs to come down in order to start profitably lending. And if we think we're going into a growth slowdown, it's not clear to me that they're going to loosen credit standards right now. So I don't know. It seems like more of a precarious situation, and we have the election still staring us in the face in 6 weeks' time, which is going to lead still to more uncertainty, right? I mean, consumers, companies waiting to see what the administration looks like, because the dichotomy between the two parties' agendas is just so massive that you just wait. You just got to wait to see, are we going to have the tariffs? Are we going to have a higher tax regime? What's the world going to look like post November 5th? Why would I be making big CapEx decisions, right now, or big hiring decisions right now? I'm just going to probably wait until January and see what happens. And I think that's going to add more uncertainty and growth. We'll see more growth deceleration between now and then on back of that uncertainty.
And labor shedding. Let's talk about the dollar a little bit. I had written in the market thoughts for clients Monday and again this morning that big cuts would depreciate the US dollar even more, which makes US assets less attractive to foreign investors, meaning there's a good chunk, about 1/5 of market participants are actually foreign holders of our US stocks. So we did get saved, right on that 100. But what is your thinking with the dollar moving forward? below and maybe, double digits soon. And how bullish is that for the backdrop of equities when some see that as a tailwind? Great, they're going to have, currency exchange, tailwinds for higher margins. Not so great because it does tempt foreign holders to dump U.S. assets. So where's your thinking on the dollar weakness and where we go from here on the dollar?
Yeah, I think it's tough. I don't really think I have a great edge here on the dollar call. Because look, I think in an environment where the growth of the global growth momentum continues to decelerate, that's typically a bullish dollar environment. So if that's my base case, I would expect a dollar to outperform emerging market currencies, the euro. I guess the yen is a little bit different because BOJ is hiking. But if in that environment, I'm not really such a dollar seller yet. I think the environment where what you're talking about is one where, we see that growth deceleration, the Fed reacts more aggressively to it. Look, I don't think that today was a particularly aggressive Fed reaction, all things considered. I think they could have been more dovish with their outlook for cuts that they did not deliver. So I think let's say markets sell off here. We start to price in 50 in November, 50 in December, and into that growth deceleration. Then I think the dollar, really starts to show more concern. But I'm just not sure we're there yet because the Fed is underwhelmed versus expectation. And truthfully, look, there is a world where the growth doesn't decelerate like I think. I mean, we saw the housing data this morning. It really seems like it's responding favorably to the move down in mortgages already. And we know, yes, there is some labor shedding, but companies are not really so desirous of losing labor so rapidly that they've spent years trying to build back up the labor force. And if they know that rates are coming down over the course of the next 18 months, and the economy is likely to get better, maybe they want to hold on to that labor. And services inflation is still running north of 4%, and wage growth is still in the 4% range. So maybe the economy has already will positively respond to the easing of financial conditions that we've had, and now even further easing of financial conditions. So, but in that world, in that world, the U.S. growth will outperform, and the dollar will rally. So, I think we need to see this data right now. I think we're at a very crucial point here with data. I think August data looks better because it was the tail end of summer, and there was still, some benefit from summer plans and vacations that were booked months in advance. But I think the September data is likely to start to look a fair bit worse. Seeing it in some of the TSA data, the checkpoint data at the airport starting to show signs of deceleration, restaurant data showing signs of deceleration, hotel occupancy rates similarly. So I think some of that very fast-moving near-term weekly data is maybe showing us the way. And if that's the case, then I think the Fed will have to react more aggressively. But if they don't, then the dollar kind of holds in. So that, and that's a little bit of a long-winded answer, but the dollar, I think, really breaks down when the Fed kind of admits they are behind the curve. They need to do more and more aggressively. And that's that's that kind of dollar down game, which will get gold to sustainably keep those highs and move higher. We'll break out Bitcoin, and we'll be off to the races.
Just popping up this chart of Dixie to basically forward expectations of cuts or hikes, and they're pretty tight, but they also lag. So this is, hold forward, if you will, a year. So that's the best fractal. So where yields go, dollar follows eventually. But the other is on the home, hold on one second, on this whole 10-year, right, composite, we are still rolling over. I mean, collectively, globally, central banks are cutting, and this is not done. As far as even just a beautiful, rounding and rolling over image for yields. So that's why your comments on the dollar, I think, are important. Is it against a backdrop of growth or not. And I would just comment on the home building and as well as the permits numbers that came out, as well as the multi-unit completions that came out, stuff that I follow very closely. Those lags so far, like the shelter and rents, like wage inflation, right? Their impact on inflation is a very lagging tell. And so the fact that we just had a big flurry of multi-unit completions is just showing what's been in process, not what's coming forward. And the same thing with permits. Oh my God, the backlog that we had in permits. And I know this space, I kind of track it way closer than I should, but they're playing catch up. So it's not at all a very good forward-looking set of indicators. But no question, this warm summer housing market call that I had this spring is absolutely picking up. We've got the 30-year fixed, falling from a high of 8 in October of 2023, and we're now at 6.25 today. So it's a beautiful thing, and it will help refis. They've already gone, I think, 128% increase year over year. So I can see that as very productive in the short term into next year. But it is also a duration destruction for banks, and it will hurt banks next year. So I'm still on this bent that we are stalking a market top as it relates to rolling over in this. Everyone is excited about easing until they realize it's into an economic slowdown. And we'll start to realize that more in the first half of 2025.
Look, Powell was asked about, the economic slowdown potential, or are they seeing something that's, sinister, and, kind of said no. But we know things can move rapidly in the global economy. And so, but look, I think as things stand right now, like it doesn't seem like things are rapidly rolling over. It kind of but I think we're, kind of maybe feels a little bit like 2001 cycle, where the economy started to slow, tech valuations were out of control. You started to get we knew Fed rates were high. Fed starts to cut at the end of 2000 and starts to come more aggressively in 2001 and kind of chases the economy lower, but over a period of time. And in the meanwhile, tech underperformed, through the back half of 2000. Then everything fell in 2021. I mean, I think that's more of a likely scenario than some sort of 2007, 2008 scenario at this point, where, we kind of get this, back then was this housing issues and leverage issues. I mean, right now, the consumer and corporations are just not as levered like they were. The governments are levered, clearly. But I think the issue now for markets is more of a valuation issue. Assets are just so expensive versus cash and versus history, that I think we could get more of an asset unwind and valuation hits before the economy, really starts to spiral over. But as we get stocks, if you start to get tech stocks down, then you start to get, tech layoffs, right? And then you start to get other layoffs. And so I think the call about a recession is more of a 2025 story, but I am concerned that some of the global dynamics in China and Europe are signaling maybe that it needs to be pulled forward. But I don't believe the Fed is, sitting on something that we don't already know. I think that, that argument, like, what does the Fed know that we don't know? The Fed knows nothing that we don't already know.
But it was funny how the only bank that, and I said, if true, yesterday when I tweeted this, that was calling for 50 basis point cut was JP Morgan. I think Citibank was actually 2 months ago. They actually said, we see 8 consecutive rate cuts. Actually, that's true. They did see 8 consecutive of 25. Anyway, point is, they were both crying for cuts, bar none. They are very important. So we're watching that from just a stock price standpoint as well. And then your comment, Marty, about CME Fed Funds forecast tool really anticipated today's FOMC move spot on. Check this out. This was literally before the 2 o'clock release. And actually, I saw this and I went, oh my God, they're totally expecting a 50 basis point. I mean, but this was ironic how we've not had this divergence from a Friday to a Monday with this, surge of expectation that the market was, not prepared for. 25 basis point, yes, we heard Powell at Jackson Hole, and then all of a sudden a sudden increase, and without unanimous consent, right? Bowman was saying no, just 25. So yeah, this was absolutely forecasting 50. And anyway, the point is, we got the 50. Now they're saying, so we got this really ultra dovish cut today, but a little bit more hawkish dot plot. Only, I would say, with a caveat that he kept repeating, we can change, we're data dependency, we're going to see what it looks like, and we can change we can go higher, we can go lower, so it was really removing a lot of the clear path for also the carry trade folks, right? When they are not sure what the Fed is going to do, when they become data dependent again, that means any little trigger that we get can be outsized for volatility. So if we do get a jobless claim number that starts to percolate higher week after week and it starts moving higher, that is definitely the Fed's fear. They don't have control of the labor market. So that would be something that would, again, I think, reignite the carry trades. So oil weak, yields weak, yen strong.
I mean, I had been postulating this, and I'm not exactly sure, but if you know that financial conditions are already incredibly loose, which they are, and you know that when you start cutting rates, that's going to further loosen financial conditions. And the reason you would be concerned about that is because animal spirits will drive up inflation expectations, which will then drive up higher inflation. If that is your concern, what you should do is you should introduce volatility around the data points and introduce volatility around the Fed meetings in order to prevent leverage positions into all of these events. And look, people, the amount of option activity and contracts that were outstanding for this meeting today was record. Yep. So people who bet on 25 lost a lot of money today. That's just the facts. So next time into the next meeting, are we going to get that level of leverage? Are we going to get as many people betting? Is the stock market going to be, as elevated into the next meeting? If this is the type of reaction we could get, we're up. Russell was up almost 3%, closed flat on the day, right? I mean, yeah. and so if these are the types of reactions that we're likely to get, maybe financial conditions don't run away, and that would be great for the Fed, right? If the Fed could get rates to go lower without inciting inflation expectation. Look, gold was up. That was a sign, oh shit, and then all of a sudden gold's down, right? Bonds were rallying and then, they sold off, right? So that's a little bit more of a Machiavellian view that the Fed, in order to prevent financial conditions from loosening aggressively, is going to create or allow volatility to rise a bit here. Then I think that's
also just be positioning that needed,
and that's what I think is probably more likely. So I'm not ready to give them too much of the benefit of the doubt, but
we got to see what happens next week. But
I think so.
I agree. Positioning was outsized, and they got their 50, so now they have to unwind that. But yes, that was a baseline bet that yields would spike, and it was actually a wrong way of putting it, of explaining that this morning. It was actually that bonds would fall with yen, with gold. And initially I was wrong. And then I was right when the day was over, but we still have a lot of positioning that needed to unwind. So I can't really trust that. We need follow through, no question about it. But one thing I did want to ask you about was
just real quick, just so that people realize, just 18 of 19 members are only still are not looking for 50 basis point cuts for the rest of the year.
Correct. Yep.
So it's not that just like a little, right? There is, 18 of 19 are basically saying it's 20 effectively. There's no 50s coming. That's I think that's right. Is that right?
Unanimous. Yeah, pretty that correct. but I
So,
wanted to show some.
look, I think that means the Fed doesn't want to deliver that. And then for next year, I wanted to say that there's a wide range of outcomes about how they see the cutting regime taking place. But there's only two dots currently that are as low as where the market is for the end of next year, right? Most of the Fed is higher. And the median dot is 3.4 and the market's at 2.9. It's like, what is going to get the Fed to move? It's only really going to move on a significant deterioration in the data. And I think if we get a deterioration in the data, that is not going to be a constructive environment for risk assets. So I think this is their
labor.
I think this is their attempt to try to push back a little bit on the market, and saying, look, we're not ready to commit to that size and degree of easing, and so we would need to see lower asset prices and a weaker economy in order to deliver what is already being priced, right? Part of this game is figuring out, are you variant versus what is priced? And right now, there's a big disconnect between where the Fed is and where the market is. And so believing that the Fed is going to cut rates, more aggressively than what they just came out and said, I think in order to believe that, you would need to believe in a much weaker economic environment, which I think is possible, but that's got to be your belief. And if that's your belief, equities are not at 5,600; they're a lot, 5,700. They're a lot lower.
You had just posted this prior, which, by the way, kind of helped with my warning with clients that not only did I see bonds softening into this aggressive Fed cut today, but that the defensive sectors, XLU, XLP, right, XLV had been really extended, not be surprised if they have a little bit of shake and bake or digestion or profit taking. So this was your chart that you had shared, and that really was, it's correct. It's the correct take. It's time for a little bit of some digestion in these extended defensive sectors. So do you think we're going to have a growth rotation? Because that's what I mean.
This is the $1 million question, right? The question
that's what we're getting asked. Q&A. What about software?
Yeah, look, defensives, caught an incredible bid on a rotation trade out of big tech and into defensives in light of a growth scare and in light of an expectation for aggressive Fed easing. And so the question now is, okay, if we don't get the aggressive Fed easing, which is what the Fed is basically modeling, right, telling you right now, we should be rotating out of defensives. Now, are we going to also get the growth scare that's confirmed, or are we going to get growth is fine? If we get growth is fine, folks are going to rotate out of defensives into cyclicals and probably maybe even back into semis and back into some tech, but I find, probably more the camp of cyclicals, industrials, and as opposed to tech, although tech, it probably does okay. If the growth scare is confirmed, right, if we start to get data that says, that Atlanta GDP print of 3% was the peak, and the back half of September data keeps, is rolling over, and the growth scare is getting worse, then I think they rotate out of defensives into cash, and equities, start to just basically get sold. And so
that's the volatility trade.
I think that's
sector rotation. There will be volatility.
Yeah, and so I think that's where and then now we're heading into the back half of September, where share buyback support is lower, liquidity typically is worse and gets drained into the end of the quarter. We have the October tax payment that gets made, right? The last 2 weeks of September are historically the two worst weeks of the year. We're going in at the highs, right? I don't know, it just kind of feels like let's, be cautious here about thinking the rotation is going to, I wouldn't be playing for a rotation into cyclicals in the last 2 weeks of September. It historically is not a good idea. Now I think if we got data in the first week of October,
we might have to wait for earnings kind of thing.
Look, if the labor data is fine, If the payroll print is fine, the PMIs show recovery, then my belief in back to school means back to reality and the economy is slowing. I need to push that back out again. Then yeah, they're going to rotate into cyclicals. They'll probably rotate, into some of these weak dollar trades, and, energy, industrials, materials, and that might be enough to kind of keep the S&P. Certainly would be good for like the equal weighted S&P. I would expect the equal weighted S&P to outperform the regular
I still
S&P.
like that one. Yep, I
So,
still
so
like
that
one.
that's but that, again,
But not energy. Energy, I'm definitely not.
yeah, look, I think again, I
about.
think it's if growth hangs in there, right? It's a if growth hangs in there trade, but
Materials,
if
yes, it's
if
still
not,
very
then I
good.
think I think we're gonna be heading lower.
So right now, this is just to kind of show we still have lots of liquidity. This is the Fed balance sheet, and this is, the E-minis, and it's on a 2-hour. So it just means above yellow is very productive. So market hasn't given up the ghost yet on a growth scare just because the Fed cut 50 basis points and, and bonds and gold fell with a dollar bounce, which wasn't such a surprise. They can resume their trajectory next week. But this is that growth value rotation that I love, ratio that I love to show and help kind of time when we are going to get a move. Last week it was Nvidia made the market for a few days, really, and then the rest followed, and we had a nice big little growth advance. But for the most part, we're just languishing here. So we haven't had, like you said, a bullish macro trigger to get growth in play again. And yet I do see some higher price targets still with semis, with NASDAQ, Apple, XLK, SMH. So I don't think that this growth rotation is done for the year. So right now it's taking a little pause. We had to get through this, this Fed day, and then we'll see what happens after. Like you said, the 3 trillion in notional value in gamma that is expiring. Not all of it, but a good chunk of it comes off the board Friday, so that'll kind of free us up. And then we've got earnings again, and the buyback tailwinds, and let's see what happens with.
Yeah.
Dollar.
I think that's the key, right? We're going to need to be data dependent here, right? And how do companies report? Are we going to get some negative pre-announcements? What is the earnings outlook going to be looking like for some of the early reporters? And then what does the data look like, right? I mean, obviously, the August data kind of came in fine-ish, but we'll start to get some of these regional PMIs, and then the PMIs and claims and all this other data. But the real question is, does the economy need this level, the fast accommodation, or does it not? And I think if the economy is fine and it's getting stimulus from the Fed, that's going to be a pretty good environment. That could be a pretty good environment for equities as an asset class. It's probably not a good environment for fixed income, but equities could do fine. But if the economy is really starting to slow, and we start to see that in claims, and we start to see that in earnings, negative pre-announcements. I saw an interesting chart that AI related names are, growth expectations. I don't know if this includes, I guess maybe this did not include Nvidia. I don't know, but something like, we're going from like mid-teens earnings growth to mid-single digit earnings growth. So there's some worries about the earnings outlook for the third quarter. I think the FactSet numbers are only looking now for mid-single digit earnings growth for the entire amount of the S&P for the third quarter, down from, I think, high singles or low double digit for the second quarter. So that's decent deceleration expected already in the third quarter. Maybe the bar is low and they'll outperform those low numbers and we'll be off to the races. But if the economy shows signs of weakness, the Fed will have to do more. And I think that's a bad environment for stocks. But we got to be focusing here on this next 3 to 4 weeks of data.
I would say the next 7 weeks before election.
For election, sure.
That's really going to be the trigger for what comes next. And if we do get Harris, it's likely year-end tax selling of size. Cannot imagine that folks are going to wait until aggressive tax policies get pushed into the first 100 days, but that's me. Okay, so any other things that you can kind of highlight that are coming into view before the next 7 weeks, I'm going to hit you up. We've already heard from Fed, what their plan is and whether they stick to it. It's all data dependent, labor, inflation, growth. So right now we have earnings also to look forward to and get through. And 2025 is definitely a clean slate in so many regards. But for right now, the highlights that you're looking into for rest of this year, are you particularly bullish or bearish any asset class? I know that you have been a long time believer holder of Bitcoin. So we've been sideways since February. Technically, if we get and stay above 70,000, it's off to the races. If we get and stay below 50,000, it's really no bueno. What's your number one kind of asset class that you're holding into next year, into the end of this year, that you think is going to do is going to outperform?
Yeah, just one thing about data. It's Powell actually winds up, he's speaking twice before the end of the month. He gives opening remarks on the 26th at a Treasury conference. That's unlikely to have really any impact. I guess it will depend on whether or not markets do things crazy between now and then. But then he is interviewed on the 30th for an hour. So, he could decide to change the way the market priced him today if he
wants,
if he so desires. And obviously we're going to get, a lot of Fed speak between now and the next meeting. But
September 30th is actually the quarter end, and you've got the JP Morgan caller with their 5750 SPX sold calls, which is typically, a much to do about nothing. They're going to roll that out for the fourth quarter. But in the past, since January 2023, we have had this JP Morgan caller pretty much hit every single quarter. We've rolled into their upside call, long story short, except for once. So I think bettors, the quants are still expecting 5750 by end of this month, which they better hurry up.
Yeah. I mean, it'll be a bit of a magnet, between now and then in 2 weeks. But look, I mean, as far as the way I think this plays out is, I think the uncertainty of the election and the Fed, call it a hawkish rate cut. I know it's crazy to say that a 50 basis point cut can be hawkish, but it is hawkish versus when market pricing is. I still think the next 4 to 6 weeks are a precarious time to be taking a lot of risk. I don't really see a lot of upside here in valuations, and I think there's risk around earnings and economic momentum right now, including in China and even backing up into the US. So I'm not particularly really constructive. And then look, and then we get to, okay, who wins the election, right? Because the regimes are very different. I mean, you're right. I think if we got a Harris administration, tax hikes are really on the table, right? And while the unrealized capital gains tax is probably not on the table unless she were to, have a Democratic sweep, which I think is a very low likely event, but other taxes are going to go up. So that creates a tough setup for end of year trading. Trump winning.
Even taxes that expire.
That's what I'm saying. It's just the expiration alone. So that would make it harder to own risk into the end of the year. On the flip side, a Trump win obviously would at first, I think, be very constructive for risk, for equities and for risk assets. But then we'd have to be dealing with what is the tariff regime going to look like? So 2025 just, to me, looks like it doesn't look like it doesn't look great. It just looks a lot of like the midst of a lot of uncertainty that we're heading into. But if a year from now, what I think is I still think gold is going to be much higher than here, because what I see from gold is I see gold continuing to replace treasuries as a neutral reserve asset. It benefits from this, potential for back end of next year inflation. And if real rates move materially negative, that's going to reconnect to its historical relationship with U.S. gold buyers. So I still really think gold's moving a lot higher. Bitcoin is a derivative of gold, but it is more probably driven by liquidity. And so I think it probably can underperform, it probably underperforms gold between now and certainly the election. And then,
Mm-hmm.
I think we really got to get an election bump, but I'm still a bull, but I think it's choppy.
Do you do
One,
silver as well, or you just stick with gold? I
I
know
think
you
I
have
think I
core.
think I need to see an economic cycle recovery in order to get bullish on silver. So I think that's going
Okay.
to happen. I think that's going to happen eventually. I don't think we're there yet. I think we need to get further
Okay.
through the easing cycle in order for that to happen. One asset class that I hate is long duration treasuries. I loathe them still. I just don't see any value
That's how you really feel,
in
Craig.
a 30-year US Treasury at 4%. In an environment where they're rallying because global growth momentum is decelerating. Can yields move down? Sure, but they are going to equity shorts are gonna really pay off in that environment. And if we get a recession, the deficits are going to blow out even more, and eventually the U.S. has to turn more of this debt out. I really want nothing to do from a structural perspective with 30-year bonds. The dollar we talked about, kind of mixed-ish here. I don't really think there's much in the way of edge there. And look, I think ultimately the U.S. is going to need to weaken the dollar over time, bring back manufacturing, reindustrialize, and that's going to be bullish for hard assets and commodities. I just think we're maybe a little bit too early to that trade, but under either administration, I think there's going to be probably a resurgence of U.S. infrastructure and domestic infrastructure build out. The electrical grid needs to be built out in order to support AI. So I think there are themes there within commodities or within utilities that could really work. And then as far as Mag 7, look, I mean, it's just such a big component of GDP. I mean, market cap of Mag 7 is like over 50% of GDP, which is, nearly
Insane.
it's really twice as much as it was, big cap tech was at the height of the internet bubble. So it's hard to get excited about big tech continuing this pace of momentum as the money like rotates out. It's just too big a part of the economy, and the earnings momentum is just not there to support that, just those valuations forever. So I think you're over time looking to high grade a tech portfolio into best in class, and but really shift capital out of that into more real economy sectors as we push into 2025 and beyond. Just the market caps of copper miners, or it's just too they're too low, right? It's just too low versus where Apple is. And so small moves in Apple from, I don't know, from 3 trillion to 2.5 trillion, that $500 billion means a lot when it goes into some of these materials, industrial spaces where the companies are a lot smaller. So I think that rotation is likely to continue next year.
I like that as well. Archana also mentions this SPX 5750 that I just mentioned earlier that we kind of track like a hawk. Is not even at an 18 delta. So right now it's only got a few days here to hit. But Julian asks about QE, and just a comment real quick. Today, Powell was asked about their continued QT. He said that will continue. They're not interrupting. They're not changing the amounts, etc. So
look, I think we can just keep watching bank reserves for that. I mean, it's basically bank reserves are up at 3.3 trillion, and I think there's still about 300 billion in the RRP. So you kind of combine those together, you're at 3.6. Fed's doing like 25 billion a month of QT of treasuries, and maybe mortgages will pick up a little more with refi. So, but no more, really more than 30-35. So at 3.1 trillion or so, which is, let's say, 500 billion away, the Fed can do another 6 to 9, maybe even 12 months of QT. I think that's probably what is to be expected. Now, again, if we get a big sell-off, and then they'll adjust. But I think they're doing QT, for the next 9 to 12 months until reserves get back down to what they deem to be ample, which is what they've said is really in the $3.2 trillion range. So right now we're at that's current reserves plus the RRP. So that's right now we're at like 3.6. So there's still some room to do. And Powell was asked that today, and he said, "Yeah, we're just gonna
Keep on.
rate cuts don't really affect that." One thing we'll see is, as cuts come down or as cuts come in, you get less yield in the RRP, right? Right now, the RRP yield, which is going from 5.3, got cut 50 basis points, going to go down to 4.8. So it's less attractive to keep money in the RRP. So I would expect, over the course of the next few months, the RRP probably will get drained. By the first quarter of next year, the RRP could be very close to zero.
And we've got that facility, the BTFP, which is
That's going away too. So that's still 100
in
billion. So we
March.
know that's going away in March. So yeah, look, I think we're timing. I think the Fed is like timing for a June to September end to the QT program. I think that nothing that they did today or that they've seen over the last few weeks would suggest anything different. The only other thing I'd say is that Fed does do a 5-year review. And next year they will give an update on what they've learned in the 5 years. I suspect they'll give some. I don't think they're going to give any guidance about that at the December meeting, but they may talk about what they're going to talk about. And the composition of the balance sheet figures to probably be something that they talk about. There's been discussion that the Fed should hold no mortgages, the Fed should hold no duration, they should only hold bills, and they may do that over time as a way to kind of fix what their balance sheet looks like. But that's not a concept for today, but that is something to think about for next year.
And no changes in QRA, which is Yellen's quarterly refunding announcement at the end of October. We kind of.
Yeah, I mean, she's basically said to expect, even though deficits have gone up, don't expect any more in the way of duration. And her announcing something 5 days before the election seems very unlikely. So I would look forward to, the next big move from Treasury in January with the next administration kind of deciding what that's going to look like. Eventually, they're going to have to term out some of this debt. They should be doing it when term premiums are zero or negative, where they've been, but they choose not to. So we have to trade accordingly.
And real rates keep rising, so this is another issue. Okay. So, and Nell's asking in regards to odds for gold, Bitcoin. I think you answered all of this a little bit earlier. We don't really have a FOMO-driven retail run right now, but we could if we get some other macro bullish trigger and/or earnings. But otherwise, our major one is November 5th.
Yeah, exactly. I mean, look, the seasonals for Bitcoin are very strong in the fourth quarter. Seasonal for most things are strong in the fourth quarter.
That's true too. Yep.
But a Republican administration is more constructive for crypto and for Bitcoin than not. So. Trump is trying to fancy himself as a pro Bitcoin candidate, and he's talked about a Bitcoin strategic reserve. It's probably a lot of BS, but a Trump win will be bullish for Bitcoin. No doubt about it. So I think that actually will be an interesting way to get leverage to a Trump victory, depending on how your portfolio is set up. If you're going into that and markets are reeling and we're negative and we're concerned, having some Bitcoin calls for a Trump win, I think is actually a pretty interesting way to play a Trump victory. So kind of keep that in mind as we get closer to the election.
And last question under webinar chat. What about small caps as outperformance because of falling yields and rate cuts? I know you and I are both like, it's 40% or, unprofitable zombies that will get wiped out in the next recession. But as it relates to a very strong proxy for rate cuts, small caps.
Look, I mean, if I'm just pulling up the chart right now, small caps have outperformed NASDAQ from the highs in early July by a fair bit, but basically for the last 10 months, the ratio has gone nowhere. There's been a bout of small caps really outperformed from November to the end of last year, then underperformed in the first 8 weeks of the year, then went flat. Then when NVIDIA reported in May, NASDAQ really outperformed, and they've given all that back, and we've kind of just mopped around. So I don't really. in a deteriorating growth environment with 40% of the index having negative earnings, like I don't think that there's a real alpha trade being short NASDAQ and long small caps. I think they'll probably just wind up trading more in line with each other kind of over time. Look, but in an environment where growth is fine and maybe starts to reaccelerate and has benefited from the lower rate regime, then that is a good environment for small caps. I just don't think we're there yet.
Okay. Yeah, and we're getting a thank you on that. Since we're coming up, we hit the power hour. I want to thank you again, Craig, so much. It has been a joy to work with you over the years, first as client, advisor, contributor, and then manager of Edge. It's been great. We've all benefited. Clients in particular have been able to hit you up for interpretation on macro and market moving events during the day in the Slack channels. We're definitely going to miss that engagement. And then, of course, how you are actively trading around your positions into these kind of big pivots. So thank you for sharing all of your insights, your education, your patience, doing this every week for clients or the public. It has been just an honor to work with you. And I want to thank you so much and wish you well and all the best to you and your family.
Thank you. Appreciate it. Yeah, thank you very much.
And
well, I'll definitely come back on. And when you need somebody to fill in, and we'll have another go at it. But yeah, this is my last official one. Folks can find me on Twitter. They know where to find me, and
yes, they do.
We'll have some news about where I might land up in a few weeks' time. But
you'll be in good company.
I do appreciate all the support you've given me and platform, and it's been a good run. It's been great.
I really, really appreciate you. Have a great rest of the trading year. And thank you so much, everyone, for chiming in today. I appreciate your presence and your patience. So yes, good luck.
All right.
Good luck, Craig. You're getting them now.
Thank you.
All right. Cheers, everyone. Bye.
Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.